Hey, Saif, it's great to see you. Thanks very much for joining us this
Thank you
evening.
very much for having me. It's a pleasure.
Yeah. So it has been 2 years since you published the Bitcoin Standard, and a lot's happened in that time, obviously. So we'll try and get to some of that. But I think, if you wouldn't mind, can you kind of set the stage a little bit for one of the things you're known for is the Austrian economics. Um, uh, Part of your thinking. And I think for a number of Bitcoiners in the room who aren't yet aware of the interrelationship between Austrian economics and Bitcoin and how they kind of go hand in hand, can you just give us a little bit of background on that?
Yeah, I think in my book, I argue that basically Austrian economics is the only version of economics in which Bitcoin operates. And I think this, in my mind, explains why, among Bitcoiners, knowledge of Austrian economics is far larger than among the general population. I think pretty much most people who read about Bitcoin are still at least familiar with the term Austrian economics, and they realize there's a different school of economics out there, even if they may not be very familiar with what the teachings are. But I think the reason for for this is ultimately that all other schools of economics come from what is called the Chartist school, or the state theory of money, in which money is considered the creation of the state. So the state decides what money is, and the state passes a law and it tells you have to pay your taxes with it, and that's the end of that. And if you don't pay your taxes with it, you go to jail, and then you don't have any money. So you have to use the money that the government is going to be mandating.
Yeah.
That's the state theory of money. And according to that, we need government. And in fact, one of the main rationales that is given for why we need government is that we need government to provide us with money, because otherwise, the market wouldn't be able to do it. So with Bitcoin, we see a living refutation of that, because we see a global monetary system that is doing billions of dollars of worth of cross-border settlement every day, and it doesn't need any government to supervise it or authorize it. And so, I think part of the reason that mainstream economists have been so dismissive of Bitcoin is that it flies in the face of how they would like to understand money, from the aspect of the government control, the state theory of money. And then the second point, why it makes sense in Austrian economics and why it doesn't make sense from a mainstream perspective, is the issue of the limited supply. And this is something. This is why I became fascinated with Bitcoin when I first heard about it, because it is something that I had been obsessing about, the question of the money supply. Does the money supply need to grow in an economy? And in my mind, I used to think, there's no good reason why you would want any increase in the money supply. Keep the quantity fixed, and money like that would be better. So, and I'd always looked for arguments that would explain why this would be a bad thing to have a money supply, and was never satisfied. So Bitcoin comes along, and lo and behold, it works. So I can understand why, if your entire worldview in economics is built around the idea that we have to increase the money supply for the economy to function, this might be something that you're going to feel a little bit uncomfortable around and skip over and go read about something else.
Yeah. Well, you've spoken previously about free market non-governmental money and the sound money principle, which, very, very simplified, says that money is the market's choice medium of exchange, right? So the people have to choose it, and obstructs the government's propensity to meddle with the system, right? So from an academic perspective, how complicit do you believe that our academic institutions in the West specifically have been instilled in, or have they been instilling this inflationary-based Keynesian school within our economic and political institutions? Are they the ones that are driving this?
Very. In fact, I'm currently just today, before getting on this call, I was working on my new textbook, Principles of Economics, which is my next big project, in which I'm trying to develop a textbook in economics, accessible and readable to the modern reader, and that communicates what I feel are the most central concepts in economics. And I was just going over one of the most famous and most widely utilized textbooks in universities today, Greg Mankiw's Principles of Economics, and it's absolutely astonishing. I was looking at saving, so I went and I searched through the index for saving. I was going through all the mentions of saving, and it's like a bizarro world version of reality. It's a completely different world in which saving is just defined completely differently from how accountants, not just common sense and what your grandmother told you about what saving is, but also what your accountant understands the difference between saving and investment. And all these theories are built around this. And I think, if you look at it a little bit critically, rather than looking at it from the position of just deferring to authority, if you try to think about it critically, it's quite clear that there's an answer that they want to arrive at, and they're doing a whole bunch of numerical huffing and puffing in order to be able to arrive at that answer. But if you try to really reason it from first principles and not based on authority, not based on arguments written in books many years ago, I think the reason ultimately what it comes down to is that these books are written to justify state control of money, and that's why Bitcoin is so interesting, because it's.
So given how committed we are already as a society to this modern monetary theory, if it were to fail, does Bitcoin benefit or is it irrelevant?
Yeah, it's an interesting question. I think generally most Bitcoiners tend to think that we're going to win by seeing hyper Bitcoinization and seeing hyperinflation in the dollar and all the other things. I tend to have, a slightly different perspective in that I think, it's not that hyperinflation is impossible. It is possible, and we see it's constantly happening all over the world in different times and places. But it happens because the government engages in horrific monetary policies. It doesn't happen because of Bitcoin. At least it hasn't happened yet. And I think, on the one hand, I think I'd say that hyperinflation isn't necessarily related to Bitcoin rising. And I think it's in the sense that Bitcoin can rise without there being hyperinflation. And in the other way, we can get hyperinflation completely unrelated to Bitcoin. So I think we need to separate between those two things, because the way that I look at it, Bitcoin can continue to rise in value and can continue to increase in the volume of daily transactions that it conducts internationally around the world. And when it does this, it increases in importance. And it can continue to do this for another 100 years. And at the end of those 100 years, you look back and you find that Bitcoin constitutes, say, 90% of global international money settlement volume. Or Bitcoin is 90% of global cash balances, and all the other currencies in the world are 10%. That can happen, hypothetically speaking. It can happen even without any of the national currencies experiencing hyperinflation. So we could just get, slow growth in national currencies market capitalization with faster growth in Bitcoin, and eventually Bitcoin overtakes them. That's independent of them going through hyperinflation. Having said that, I think if we do go through hyperinflations, I think arguably Bitcoin would be the solution to this in a sense, because Bitcoin provides people with the alternative that if those things happen, you can get your money out of your country, you can use it. So that's, yes, so Bitcoin would benefit from it, but only to the extent that people benefit from Bitcoin.
Well, so Bitcoin growing in importance and the correlation with saving, I think, is really interesting. And I've heard you give a talk previously around, people in that Gen X, Gen Y, Gen Z generation have not necessarily been attuned to saving, and that perhaps that has been because the inflationary value of money means, well, I'm putting this money away today and it's going to be worth far less than it is when I stuck it under my mattress, right? And even though the Bitcoin supply is fixed, it grows in importance and then therefore, holds its value. So let's, understanding that, if I've got that right, if we're on agreement there, let's shift a little bit into what some of the governments are doing. So we've got CBDCs being talked about now, and major central banks looking to experiment with digital forms of fiat. And so, is this a clear admission that they see Bitcoin as a threat? Or do they just see this as another opportunity? Are they understanding the technology now and want to get involved? And does Bitcoin benefit or not?
I mean, to be perfectly honest, the way that I see it is we've had central bank digital currencies from before Bitcoin now has existed.
Yeah.
There's really
digital fiat for sure, right?
Yeah, the majority of national currencies are essentially digital currencies.
Yeah.
They don't exist physically. And I think this, to be perfectly honest, I haven't spent much time looking into CBDCs because every time I spend any time looking into it, it's clear that it's essentially vaporware. There's no functional ability that's added on to this. Only in so much as perhaps it might be that the app that will be on your phone is going to be it is going to be connected directly to the Federal Reserve, bypassing your local bank. But at this point, this is entirely ceremonial. Your local bank's existence is ceremonial. Your local bank is just part of the Federal Reserve. So getting rid of your local bank from the equation isn't that big of a deal. At least, obviously it is a big deal for the bank, but I'm sure they'll be all right. But I think the point I'm trying to get at is the way that I see the value proposition of Bitcoin is, in the monetary policy, the sound money, the hard money, the fact that the monetary policy is something that nobody can change and that it's algorithmic. And on the other hand, the fact that it's unstoppable digital payments. It's not something that needs. It's not something that needs courts and politicians and laws in order for the institutional structure to exist for those payments to be processed. You click a button and the payment can cross national borders, and all of those parliaments don't have to do anything. So these two things are fundamentally contradictory to the mission of central banks. So I don't see any value proposition for central banks adopting this. They would be putting themselves out of business. So if they, this is those are two of the three main functions of a central bank. The third one being regulating the banking system. So if they issue something like Bitcoin, to the extent that it is like Bitcoin, it gets rid of their two of their three main functions, and so they would be trusting monetary policy to an algorithm, and they would be trusting payment clearance to private keys and public keys. But of course, that's not something that is politically feasible. Governments want the ability to freeze payments, and they want the ability to control monetary policy. So what you're going to be ending up with is, a glorified Venmo at the Federal Reserve, maybe, or something like that.
Yeah. Well, and I wonder too, if the value proposition starts to become even less attractive. I mean, if a central bank were to offer a digital currency direct to consumer, there are a couple, smaller governments that are looking at this. So basically cutting out correspondent banking or wholesale banking to offer retail directly to the customer. If I'm going back to the argument that we just made about savings and the value of my money today, and the meme on Twitter, governments just go burr, print more money. That seems an even less attractive proposition for me, considering that now I'm not even holding that cash in my hand and that ability to have a peer-to-peer transaction. You've got inflationary money, and now it's digital. It's gone digital.
Yeah, I think if you delve deep into the mechanics of how the modern, shouldn't say modern, the ancient 20th century monetary system works, the way that money creation happens is that the banks are creating money through credit creation. And so the central bank is constantly trying to make more money and create more money, but it can only do that through more credit creation. And it can't just get credit creation to happen because we've already reached the point where everybody is up to their eyeballs in debt already. Anybody who earns a cent has securitized it and borrowed against it, and it's been resold and rehypothecated many times. So there's just not much more debt you can create in order to keep this system going in that sense. So in that sense, CBDCs might be a solution in that if they stop, if they turn it into a system where effectively the burr can go more effectively, where the central bank just hands out cash to people directly and then people go spend it, then they should be able to get the inflation that they have been seeking. And
Well, I think I have time for maybe one more question before I hand over to Johnny. So let's shift a little bit toward adoption today, right? So I don't know if you've seen it, but Fidelity Digital Assets published a report last week surmising that the number of institutional investors in digital assets is growing pretty significantly, actually, as is the number of investors who believe that digital assets should be part of their portfolio. And the numbers seemed higher than really we see in the general media or some of the major commercial banks might lead us to believe the interest is. So if you've seen the report, were you surprised by some of the adoption metrics that they've produced as part of this investor study?
I saw the story, but I didn't dig into the numbers, so I can't really comment much on it, except to say that my
like 36%.
Yeah, my impression is that number is just way too high. I think maybe you could turn it if one client in an entire bank has maybe this is the way that they calculating it. One client at a bank has it, so then that bank is counted as part of the banks that are interested. Then you could maybe get 36%. But in terms of the total market capitalization, obviously Bitcoin is nowhere near 36%, not even near. We're less than 0.36% at this point. I think Bitcoin might be about 0.2% of global cash balances. And in terms of global investment, it's probably even less than that. I don't know. I think...
Well, I thought the sentiment numbers were encouraging. So, if the sentiment numbers are accurate and, we're seeing institutional investors identifying and the value proposition is starting to resonate, then maybe those numbers might be more important than the overall number of people that they say are already in. So is it still a positive directional indicator?
For sure. I mean, I think that the interesting thing is that people are definitely hearing about it more and more. I think that as the joke on Twitter goes, Bitcoin's unique and proprietary number go up technology just does the advertising for it. Like if you're an asset manager at this point, you're looking around at assets that are not correlated, and you look around at previous performance. Every year, the case continues to get more and more compelling. Even after you get the occasional one very bad year, you still look at it in the long run. The performance is really good. So I think it's only a matter of time before they start asking questions more and more and looking to get into it. But in terms of current volume, I think it's an exaggeration, but it's a good indicator of where we might be headed.
Great. Saif, thank you so much. It was a real pleasure.
Okay, thank you. Thank you very much.
I'll hand over to Johnny and Paul.
Cheers. Thanks.
Thanks, Paul. Hi, Saif. Been following a lot of your work and was listening to the conversation with Teana just before. Really interesting sort of, maybe we could even pick up where they ended, where you ended the last conversation. So, I've been in the crypto space for a long time. As Paul said, sort of the early meetups in East London where 10 people gathered around a table at a pub called the Pembury Tavern, where you could pay with Bitcoin in 2013. A lot has changed in terms of the interest, and the interesting things that I think we're starting to pick up on is, it's required both the interest of the sort of existing institutions and the things that are in place, sort of the major banks, all the venture capitalists. That's really been essential in making sure that Bitcoin's become a lot more usable since then. At the Pembury Tavern, the owner of the Pembury Tavern actually wrote his own Bitcoin acceptance terminal on his point of sale system that you could then pay. Now we have like Coinbase and BitPay and things that are much easier. So I'm wondering, like, but that's really fueled sort of Bitcoin's rise, and how does sort of the more speculative and how important is like the Wall Street interest in Bitcoin in terms of making it even much easier for sort of the everyday person to interact with Bitcoin, and how does Bitcoin sort of survive that tension between those two worlds?
I mean, I think, to be perfectly honest, the way that I see it is Bitcoin. This isn't cool to say, and this is definitely not the sort of thing that you would want to say if you want to get funding in Silicon Valley. And but one of the perks of not having to go after funding is that you can just say those things. The reality is, Bitcoin lives and dies by one number, the number, and so the number go up technology is essential for Bitcoin's function. And I think it's the issue of use is, I think, a completely orthogonal question, because we already have all manner of payment systems all over the world that are digital and physical, that are involve all kinds of different levels of trust and all kinds of different levels of risk, and they process trillions of dollars every day through all kinds of different things, from wire transfers to all of that. So I think we already have a massive infrastructure for payments, and the idea that Bitcoin itself is going to disrupt this entire payment infrastructure that is out there for merchants and for remittances, I think is quite far-fetched. Bitcoin, and the point that I argue in my book is that you can't really think of it as if you're going to be using Bitcoin as peer-to-peer, it's just simply unworkable that the peers are going to be conducting small-level coffee and beer transactions on chain. It's just not going to possibly be workable, and nobody wants that kind of level of trust for their beer or their coffee anyway. And nobody wants to have everybody in the world's beer and coffee take up processing power on their laptop. It's going to involve all kinds of different layers of scaling and solutions. And in reality, a lot of the current existing solutions can't even be adapted to Bitcoin. So the unpopular fact that I like to keep saying is that really Bitcoin is the metric for Bitcoin success is the number go up, because Bitcoin winning is Bitcoin capturing more of the global cash balances. This is really the market for Bitcoin. It's how much money is held in Bitcoin. And then the more money is held in Bitcoin, the more solutions are going to be developed for paying and settling with Bitcoin. And these are going to be Bitcoin native solutions, things like Lightning and Liquid, and as well as completely second layer solutions, as well as existing solutions that function for fiat but are going to be adapted to Bitcoin. So you see things like Fidelity, for instance. They could potentially bring in $4 trillion of Bitcoin demand. That's how much money they manage. And they're already holding $4 trillion worth of other stuff for people. So those people are already trusting them with most of their money. So they could also trust them with some of their Bitcoin.
And I think that's interesting, because for me, at Chain Analysis, we obviously serve a lot of different customers, including the financial institutions that are looking to get into this space. And the thing that I come across the most when having conversations with those asset managers is they're all looking for fundamental data about the utility of Bitcoin today. So they are trying to assess, how much of Bitcoin is being used for the different purposes, how much is used in payments or cross-border payments, or is there any inherent use, and is something like a commodities analogy sort of useful for Bitcoin, where there is obviously the demand for it as a store of value or an investment vehicle, but then there's also just some underlying utility behind the system that they want to feel some level of confidence in. And so, do you think that does that make sense in driving up the amount of asset allocation towards Bitcoin? Do we need to be able to say, how much are people actually using Bitcoin today?
I mean, I think it's I don't, because I think it's people who were using gold for its monetary uses were not using it. We're not thinking, "What are we going to use gold as money?" Because other people are using it for cell phones or for electronics or for all these other or for jewelry. In fact, it's the other way around. People used gold for jewelry because gold was money. It's not. That's the reality of it. And I think until Bitcoin, we never had a purely monetary good. We'd only had goods that emerged on the market, and then they would be used as money on the side, effectively. And with government money, I think this is where modern investment managers get their bias, and that in government money is not something that has a function in and of itself. And so, the best way to run, best way to optimize your personal finances is to have as little cash as possible on you at all times. You want to make your cash work for you. So you want to have as much money go toward investments, or you want to spend. You want to only have cash as much as you need to spend over short periods, and because cash is trash, as the investors say. And I think the value proposition that I would tell them is, that on its own, just holding it, having a cash balance, is a use, and there's nothing wrong with that. I mean, it's a use case, and it's no different from any other use case. Well, it is different. Obviously, all use cases are different, but I mean, it's no different in terms of its legitimacy. Nothing about it means that it's not a real use case. So people want to hold cash balances, and they used to hold significant cash balances in gold. And it is, I think, enormously valuable for individuals and corporations to have a hard money that is expected to hold on to its value, because then they're able to hold cash balances that give them security and that allow them to capitalize on opportunities that emerge. So I think, just emphasizing the value proposition as cash itself is I think, is the correct answer to this, rather than any underlying thing. Because I think when it comes to the payment network, if I may add just one small thing, to make a payment network work, a lot of people have been trying to come up with all kinds of solutions and with all kinds of different digital currencies and payment networks. But ultimately, payment networks are about networks of trust, down to the level of your local bank knows where you live, and they can, they have information about you. And in many places, of course, there's much more intimate structure, but there is a net of accountability of people who know each other, and that's what it ultimately comes down to. Even in systems that are primitive, more primitive than the modern banking, like in Hawala systems, it's there are networks of trust of people who know each other, and that's what payment settlement depends upon, because you can't be moving the asset itself, the hard asset of the backing the transaction. You can't be physically moving it in order to make payments, because that would be enormously expensive. So there's always going to be an element of credit in payment settlement, and that's only going to work at the local level, I think.
And I think that's interesting. I mean, the other thing that's really evolved since sort of arriving in Bitcoin has been the emergence of Bitcoin lending, and the idea that people don't typically lend. If you're talking hard money, particularly longer term, there hasn't been. There are derivatives markets for all the commodities, but the idea being, should Bitcoin have a forward-looking curve that the market understands, and what have we seen? What should we expect to see in the evolution of like a Bitcoin forward curve that the market has? Should we expect that to arrive?
Well, I think it's I'm going to answer the question specifically. I think there are two different ways of answering that. At the point in which Bitcoin exists along with other monies, and then at a point in which, let's say, we just have a Bitcoin-denominated economy where the only money is Bitcoin. I think that's maybe the more useful question, because now, you know, in any case, I'm just going to go to the situation of an all Bitcoin. In my mind, the way that I see it, and I mentioned this in my textbook, I think it's likely that you wouldn't find interest rate lending at all in Bitcoin. I think a Bitcoin economy, a hard money economy with a completely fixed supply, would most likely end up just having banking divided into two tasks: deposit banking and equity investment. So I think basically it's like Islamic banking. I think the fact that the money supply is fixed just makes the asset itself attractive to hold, which then gives people something like a positive return simply from holding on to it. And then the cost of the storage and the security and the convenience of payment settlement while storing it means that there's a significant value proposition for just having your money stored safely. So people will be happy to pay for deposit banking. And I don't think in a Bitcoin economy, that's really the key point. In a Bitcoin economy, it's not possible to run fractional reserves. I think that's really what it comes down to, because it's going to be, it's very easy to, it's very easy to become illiquid, and there is no central bank that can print money to bail you out if you become illiquid. And so therefore, you know, I think people could engage in it, but they would face illiquidity, and then their illiquidity is, in a world of hard money, I think illiquidity is no different from insolvency. You'd become insolvent, and then effectively people who have liabilities, people who have assets on the bank will take a haircut. So I can't really see fractional reserve banking existing more than the fact that, you know, if it does exist, I think the coins will just simply be discounted to the extent that a bank engages in it. So then, if you don't have fractional reserve banking, then I don't see how the bank can lend other people's deposits without fully maturity matching. And so if you have full maturity matched banking, then, okay, you could say that you'd have an interest rate there. But if you look at what is happening historically with interest rates across the last 5,000 years, you see that there was largely a process of declining interest rates. And toward the turn of the early 20th century, interest rates had dropped to around 2%. That was the lowest interest rate on the Bank of England sovereigns. So we were getting pretty close to a lower interest rate. And interest rate is effectively, from the Austrian perspective, it's determined by time preference. And so as people's time preference drops, they save more, capital becomes more and more available. And so capital becomes more abundant. And so the price of capital drops in terms of the interest rate. And then I think you can continue that process to a point where the scarcity of the interest rate the scarcity of the capital is no longer about the availability of capital. In a world in which you have a hard money and people's time preference drops a lot and everybody holds significant cash balances, there's no scarcity of capital. There's a scarcity of trust, and people trusting you in order to give you their capital. So imagine yourself in a world in which everybody's got significant amount of cash, the equivalent of everybody having, or let's say the majority of people having $1 million in cash sitting in their bank account. In real terms, let's say. In that kind of world, if you want to start a business that needs $1 million of capital, it's not very difficult to find people who would be willing to invest. The difficult part is getting them to trust you, to decide that you are a positive return over keeping that money in a safe and watching it appreciate. So in that sense, I don't see why they would want to take on the risk of investing in somebody without when the risk is capped. You know, why would you want to take on an interest rate of 0.5% or 1% or 2% when the risk of loss is uncapped? Because if you run away with the Bitcoins, or your project goes bad, or if you get robbed, there's no authority to bail me out. So I'm sharing with 100% of the downside. I don't see why I would want to share with the upside. And I think it might be the manipulation of money that makes this possible. It's a very complicated answer.
Yeah, so I think that, I mean, obviously this is like pretty far out, but I think that the way I see things today is, in the venture capital world, and sort of going back to the start of the conversation, is they've taken a lot of the investors are now able to both either invest in cryptocurrency startups or cryptocurrency assets. And the interesting thing that you can see in the world today is that investors might choose to invest in cryptocurrency startups only if they think that it outweighs the return of actually investing in, say, Bitcoin or Ethereum if you're a DeFi investor. So there's really and as a business, you have to prove that you have an outsized return on investment relative to the success of say Bitcoin. And time and time again, we've had to go to present to people and the biggest question that they come up against is, okay, if I'm assuming that Bitcoin is wildly successful to make sure that your business is successful, why don't I just buy Bitcoin in order to gain in that? But then kind of back to my original question is that much of what's happened in Bitcoin's history and much of what will get Bitcoin to be something that is, much more significant in the global economy is the conviction of Wall Street and venture capitalists actually looking at this industry and saying, what are the businesses that can be built that actually, can get an outsized return, even if Bitcoin's successful. So that's, yeah.
I mean, I think this kind of problem is kind of contradictory. If Bitcoin is beating all Bitcoin startups, then Bitcoin doesn't have anything to worry about. We don't have a problem of getting more money into Bitcoin if it's already beating all the startups. But I think one way of looking at it is that currently Bitcoin itself is, in a sense, like a startup. Like right now, buying Bitcoin, it is a cash balance. But at this point, because it's, I like what Pierre Rochard says, which is that it's a growth currency. It's a currency that is expected to be held, that is expected to appreciate. So people buy it as a speculative, like investing in a high-risk startup. And this is a novel concept for currency. Nobody speculates on, all right, I'm going to go buy the Chinese yuan, because I expect it's going to appreciate significantly over the next 10 years. But this is novel. But I think you could think about it, on the other hand, as if it's like investing in a startup central bank that's out there competing with the world's central banks. And frankly, if you put it that way, there's really very little business ideas that can beat, that are better for humanity than putting central banks out of business.
Right, but the issue is that if you look at how Bitcoin gets adopted today, or how you might go and buy Bitcoin today, you need a lot of infrastructure to take the $4.7 trillion or whatever of assets and move that into Bitcoin. So, in order to be able to do that, there's going to have to be businesses that are running that make this process, actually achievable. So, what we've managed to do is make sure that there is actually greater trust in the cryptocurrency ecosystem, so that actually people can get more money into the market, so that things can be built and people have access. And so there needs to be some infrastructure. Bitcoin is really not like a technology that's actually available to a lot of people. The number of people I meet that actually run a Bitcoin client has drastically reduced over time, as more infrastructure is being built. So yeah, and that's where I think that Bitcoin does have a really interesting property that for a lot of ways it pulls itself up by its bootstraps, in that it acts as this sort of store of value, this speculative asset that attracts, as the number goes up, it attracts more peripheral investment, which helps it pull itself up more without actually the system itself needing to pay for that development itself. Like Bitcoin hasn't had to fund itself, like the development of the infrastructure around it. It's really just made a massive attraction for all these businesses to take hold. But at some point, there is a tension between sort of, if the infrastructure is mature enough, people would then buy Bitcoin and then leave the infrastructure to sort of go by the wayside. And that's where I think that there's sometimes a little bit of tension between the people who are really sort of speculating on the currency underlying and the need to still pay down the sort of infrastructure that people need to access it.
No, absolutely. I think, I'm not in any way trying to denigrate the work of building Bitcoin infrastructure at this point. It's extremely important. And of course, people will invest in it. Just because holding Bitcoin might seem attractive, or is extremely attractive, doesn't mean that the people will only invest in that, because as you accumulate more and more Bitcoin, the marginal benefit from accumulating more declines, and then you start thinking about other things, and you start thinking about building this infrastructure, about the long-term impact of being one of the forerunners in this field and investing in something so early. So of course, yeah, I think it's Bitcoin's success, I don't think, detracts from investing in the Bitcoin infrastructure and Bitcoin startups. I think the more the number goes up, the more that people can fund these kinds of investments.
Hey, sorry guys, I'm just gonna. I just want to make sure, just conscious of time, that we've got some audience questions as well.
I've got them. I can ask them, and we can start with the first one. So, why? So the first one is for me. Let me just read it out. It's surely Saif's libertarian and Austrian economic background must be totally at odds with chain analysis. I just want to confirm that that's correct, and then I can answer the rest of the question.
I think in principle, I can't have a problem with people doing blockchain analysis. I think it's important to keep this in mind in terms of the way the blockchain doesn't owe you, or the universe doesn't owe you covering up your tracks, and that's on you. And so I don't think that when you put information outside, when you put information out into the world, you lose the right to tell people what to do with it. In the same way that if you throw money from your balcony, you can't say that this is my money, and you demand that people in the street don't pick it up. And I think this is why, in terms of property, I don't believe that there is such a thing as intellectual property. I don't think intellectual property exists, because I'd urge you to look into the work of Stefan Kinsella on this. So in that sense, I don't think there's anything. I can't say that there's anything per se wrong about digging through the blockchain, because you don't have to leave your tracks. You don't have to use the blockchain. And I think also from an OPSEC perspective, it makes no sense to be expecting that companies will not do this thing. That people out there are not going to be trying to do their best. And I urge Bitcoiners to always keep this in mind, that there's a lot more firepower that could be put into uncovering your tracks than you could put into covering your tracks. So you want to be very careful about what you do with this. Where I think the problem I have is when chain analysis or these companies would use market to governments and essentially use them as requirements for regulatory clearance, and trying to. I think there is the issue of the overconfidence of the results of the chain analysis, and I think this could be a dangerous thing for many people who could get implicated in court when chain analysis might not be as reliable as we think it is. And I think the other thing is to try and to essentially get a regulatory leg up, or make it so that exchanges don't get regulated unless they get approval from this, because I think that oversells the capacities of this, and I think it could it can be I can see this developing into a kind of if government, I think in a free market, I would expect that in the free market, something like this would be used for good. That if somebody takes coins, they might be traced and people might be able to find out who stole the coins. But I think if it becomes a government regulated, then it's most likely not going to be used in the service of the clients, and it's more likely to end up used for essentially regulatory arbitrage. So, effectively, you're just selling people licenses to say that they're people pay you money and you clear their transactions. That's the dangerous thing about this, I think.
Yeah. So, I think that a couple of things on my side, and then we can sort of move on, is that we take our sort of data integrity, pretty seriously, and the way that we think about notifying exchanges about potentially risky activity is about ensuring that that's accurate, and they combine that information with other data points that they have in order to confirm suspicion before reporting suspicious activity. I have a slightly different view on the government front, which is that I think that had the government not been able to actually understand what was happening in cryptocurrencies and solve a lot of these more prominent cases around child abuse material and other types of things, cryptocurrencies would have had a much harder time being a regulated asset that people can actually own. So it's one of those tensions, and I totally understand it, but that's sort of my viewpoint. Permissionless is crucial for Bitcoin. How do large institutions allow permissionless transactions? I think that to sort of steal a little bit from Saif's view here is that permissionless is really important in terms of being able to ensure that you can have autonomy and custody over these assets. And I think that is the core value proposition. I think the ability for you to continue to trust larger institutions to manage your money and to gain exposure to the overall industry is also something that's a powerful thing behind Bitcoin. And if from our data at Chainalysis, we can see that most of the people who interact with Bitcoin today go through regulated exchanges. And so I think that the value, sort of why they're at their institutions, is the fact that you can go permissionless, you can go take it off the exchange, you can do whatever you want with those Bitcoin. But I don't think it's necessarily important that the larger institutions need to allow permissionless transactions. I don't think it's possible. Is kind of
no. I
point.
agree. I agree with you. I think it's at least a quarter of Bitcoins that exist on KYC exchanges. So a quarter of Bitcoiners have their IDs next to their Bitcoins, basically. And I think another quarter or so, I don't know, actually, I should ask you that question. What percentage of all Bitcoin's ownership could you think you could identify? And I'd be interested in thinking about what you'd say.
So, I mean, when we talk about identification, and this is a little bit of a longer, we've only got a minute left, but when we talk about identification, we mean mapping it into services. So which services are responsible for those transactions? Like, we're not going to map into individual ownership. But for that, we, in something like Bitcoin, we know something about over 80% of the transaction volume that goes on between different institutions. So we have a pretty good understanding of where that is, and we can also see how long different Bitcoin have been sitting sort of dormant or maybe lost or over time.
I'll just add to answer this question. I think the reality is, given that I think the majority of coins are in exchanges and KYC, or one hop or two hops away from exchanges, I think in my mind suggests something that's not very popular to say, but most people are in it for the number go up. They're not in it for the permissionlessness. The real importance of permissionlessness for me is that it is the only reason that we can get number go up. It's the only reason that we can prevent Bitcoin from getting shut down, from getting the monetary policy compromised.
Cool. I think that there's a couple of questions. I'm not sure if you've seen them, but have you worked with institutional players or hedge funds to help them understand the new asset class? I presume the answer to that is yes.
Yeah, I'm up for hire.
That's great. And when do you think the block subsidy will be a substantially smaller incentive for mining compared to the fees from transactions? Do you think we'll definitely get there? Funny, this question. So I actually wrote my master's thesis 5 years ago on this question. And I think it's, I can't even remember what my answer was at the time. It was probably about 2030, I think, where things start to flip between the block reward and transaction fees. In order to ensure incentive compatibility,
I'd say probably 3-4 halvings might be it. So around
something like that. And then is eventual collapse mathematically baked into the design of debt-based fiat monetary system? I would say that I'm going to guess that your answer is yes, and my answer is probably
no. I don't think it is. I think first, there's no design there. They're making it up as they go along. It's evolved, and I think in my next book, The Fiat Standard, I make the case that we can, as I was saying earlier, we can transition out of this kind of mess monetary system into Bitcoin. Bitcoin is the technical upgrade for that, rather than we don't have to all go through Venezuela before we can have Bitcoin. We can just upgrade, like somebody getting rid of their crappy old PC and just buying a new modern one.
Cool. That sounds really optimistic and a good note to end on. Thanks, Saif, and thanks, Paul, for having me back. It's a pleasure to be back at Coinscrum.